Thanks so much for tuning into BQ Conversations. I'm your host, Niraj Shah. We're talking about the churn that large AMC houses have seen in their portfolios or have enacted in their portfolios. And in light of that conversation point, we have with us today Mr. Vinit Sambre of DSP MF. Vinit, thank you so much for taking the time out and speaking to us today.
Thank you, Niraj. It's nice to be on the show. Thanks, everyone.
The pleasure is ours. Vinit, has the portfolio, as things stand, the composite portfolio, let's say, undergone a significant change from what it was, say, 12 months ago?
So, see, broadly, I think the way I have sort of managed the portfolio is generally taken more long-term view in terms of and holding on to good businesses where we believe that these companies would sort of would be potentially creating wealth over a period of time, and hence the churn generally tends to remain low. But at the margin, yes, definitely we have carried out some changes in the portfolio. I think overall as a house, if I may say, we have gone and increased our exposure into banking and the lending businesses, as we see that there are good signs of them recovering with good balance sheets. As far as my specific portfolios are concerned, we had made some trimming towards the beginning of this year in the mid-cap IT space because of the heightened valuations at which they were trading. But now we've started looking at those because if we see YTD, the IT sector has underperformed, and some of those excessive valuations have also sort of come off. So I think that provides us an opportunity. Maybe one quarters more, there will be some more pain, maybe driven by the global recessionary fears and all of that. But I think that will only provide an opportunity, is what we feel. Incrementally, again, as a house, we have enhanced our exposure into healthcare as a category. Again, if you see, notice that healthcare is underperforming YTD, but this also provides us good entry points into a sector which is neglected right now. Markets are at the highs, people are just chasing the performers, and here's a case where these are lying maybe sidelined right now because of some of their fundamental issues. But I think one looks at the core business metrics; they are fundamentally pretty sound, even after facing some bit of let's say some transitionary pressure in terms of high raw material prices or US price pressure and all of that. These companies are still delivering good cash flows and ROC. So gradually, we are also sort of looking at increasing the exposure there. We are also sort of we have a specific thematic product in that category, which we anyways have been bullish about for a while now. And we believe that over the next 1-2 years, this can become a good category to own. I think, and the other areas where we are sort of looking at incrementally more positively is where I think by and large, I would say the consensus view is also similar. Is the broader engineering thing, because I think there is a clear signs of government accelerating their capex momentum across segments like railways, defense. PLIs is sort of adding to this whole momentum. And at the other end, in the short term, as we see, some part of the consumption is a bit slow, but the capital spends and engineering companies are seeing more order inflow. So I think to align from the current perspective, and also this is a good long-term view as well. We are trying to look at some of these companies, but also aware of the fact that these companies are not trading cheap. So we are a bit cautious and slow in terms of adding to some of these names. So I think broadly, if I can just think about, these are the segments which we are looking at. On the other hand, there are, as I was talking about, the consumption trends, being slightly subdued, as typically more from the bottom of the pyramid or the entry level categories. The other observation which we have is that even within the consumer durables, which is a structural story, so to say, and we believe in that. But at the moment, what we are also seeing is that because of the inflationary pressures, these companies are facing inability to pass on the price because the demand is demand is slightly elastic when it comes to the increased prices. So we see that the profitability challenge may last for a while for some of the companies, and we've chosen to reduce our exposure in some of them. So I think broadly that's how the overall construct is as far as the larger churn is concerned.
Hmm. Just a quick follow-up. So on the themes that you've reduced exposure of late, yeah, has it been consumer durables, for example? Is it a very recent phenomenon, or is this something that has happened some time ago?
So it has been, let's say, gradual over the last 2 3 months, maybe. And again, because we like consumption as a theme with a long-term perspective, so it has been a slow, gradual, and a very calculated process where, unless and until we are very sure about, the trends having the current scenario actually having slightly durable, causing durable problems in the company, we are not carrying out those changes. We are ready to sit with some pain in some of them, but in some cases we felt that it is good to actually have little less exposure.
Okay. Vinit, your first answer makes me believe that the portfolios until maybe about a month ago, maybe, would have been largely domestic oriented with lesser exposure to export oriented themes. And you are now changing that by virtue of the buying that you may be doing in IT, pharmaceuticals, so on and so forth. Would that be a correct assessment?
Yeah. So, and in a way, I think you may also, say that. In general, we have decent exposure, I would say, to the international businesses as well, because once you look at us, the specialty chemical pack, let's say, which is already part of the portfolio where we are not sort of doing anything. I mean, that includes a good chunk of business coming in from international markets. There are, let's say, a couple of these auto ancillary companies which we own, which also has an international exposure in a way. So I think we have a, let's say, decent mix. It's not heavily domestic oriented, but anyways, at the margin, we are also, it is more, let's say, bottom up approach to say that IT or pharmaceutical, which are, let's say, more having more exposure to the international. So that will maybe increase some bit of that skew towards the international market. But I think that's a approach which you're right in a way.
Okay. The other question is, while you run one of the most successful small cap schemes, I'm tempted to ask you that in your flexi cap stroke multi cap strategies, has the skew of large versus mid versus small changed from what it was 6 months ago?
I wouldn't say so. I think broadly the mix has remained same. It is just the I think at the margin there is incremental, let's say, change in the type of companies which one would like to own. As I mentioned, there we have seen incrementally exposure being taken to the banking and financial as a category. Healthcare is what I said gradually. One is looking at increasing exposure. So I think broadly these are the large changes, is what I would say. But
Okay,
the
but
big mix has not strategically changed as such.
so between large, mid, small, you really haven't made too many changes per se.
Yeah.
Okay, great. A couple of follow-ups before we wrap up. Vinit. One of them is on BFSI. Now the whole street is bullish there. Everybody seems to be parked there. The arguments are compelling. My question to you is: do you see this as a 6, 9, 12-month phenomenon before it gets priced out, or do you reckon this has actually got a much higher longevity than what it would have been otherwise?
See, while the environment today is very fluid, and one data point changing anywhere in the world can lead to structural changes in the thought process in the minds of investors. So that's a big challenge. But anyways, I would imagine that it has come out from a long period of, let's say, not only underperformance but also problems, so to say, with the bad quality assets and high credit cost, low credit growth environment. All of this is changing. The other aspect is that the if we look at the overall economic cycle, we are from the lows. I would say since demonetization, we have been struggling in a way, with multiple, let's say, challenges, which we have seen, COVID being the bigger one. I think the now economy is probably ready to look at much more optimistic scenario over the next 4 5 years, and banking being proxy to the economic revival, I would say they have a good scale up possibility over the next few years. Now, what is going to be very imperative is, you asked a very important question, that is the stance going to change now. See, right now, the good thing with the banks is that not only the credit growth is happening, but the profitability or the NIMs are also sustaining and doing well. So there could be probably one change or challenge which the banks may see, as they will have to aggressively raise deposit cost, and that may have some pressure on the NIMs, but that is, let's 2 or 3 quarters ahead. So at that time, probably we may stabilize some bit for these, but then incrementally, if the credit cost continues to remain low, credit cycle continues to remain positive, I think the earnings related growth should drive the valuations as well. And again, as a starting point, let me say that these banks are also trading at multiple which is reasonably lower than their 5 year averages. So I think the starting point is also not that high, as there was good selling by the foreign investors, and the banking sector overall has seen correction, which brings them at a decent valuation zone.
There, Vinit, would you believe that larger banks would have a better chance of withstanding the pressure of higher deposit rates? Would you be again skewed towards the larger versus the mid-sized banks?
I would say that, because not only that they have the benefit of that, but also if one looks at the growth, I think the larger ones have beaten their mid-sized or smaller counterparts. So, and also in terms of the, let's say, technology adoption, the ability to spend a lot more is there with the larger ones. So I think justifiably they have a probably better chance of capturing larger growth or larger market.
Got it. My final question, Vinit, I heard in one of your answers on this conversation that you've kept your spectrum exposure largely as is. Did I hear that correctly?
Yes.
Okay. So my question is that it's a sector that had a dream run for 7 years, then has had a bit of a speed bump in 2022. Do you reckon we are past the speed bump of sorts? Or is it, I mean, the longevity may be there. Are you betting on the longevity, which is why you're staying invested, or do you believe the speed bump is behind that?
No, I think speed bump is still there. Maybe another. I think because these companies are exposed to the international markets to the extent that the, let's say, the slowdown is impacting European nations and the developed world. I think to that extent, some of these companies could face slowdown in their business as well. But you're right. We are looking at the long-term picture. And when I say that we've not made changes, it's let's say the last 6 months, maybe not big changes there. But over the last 10 years, we've been owning these businesses. We have gradually trimmed, let's say, since the last 2 or 3 years, because we felt the valuations had scaled too high, and a lot of the good positive developments were getting factored in into those. So we had marginally trimmed our exposure, and now we are holding on with those with a long term.
Vinit Sambre, always a pleasure talking to you, no less today. Thank you so much for joining us and giving us your sense.
Thank you. It is absolutely my pleasure. Thanks, Niraj.
Thank you. And viewers, thanks for tuning into this edition of BQ Conversations.